Assalamualaikum and good day to Madam Azira. Today in this video, we are going to present about our business management project. Before we start, I'm going to introduce my teammates. In my team consists of 8 persons, which name Putra, Zulfikri, Husaini, Shafika, Raiha, me, Ani Sofia, Melissa and Irdina.
Assalamualaikum, my name is Yunusufa Mitinasuri. My number matric is A24A3322. Okay, for this assignment, we choose two companies to analyze, which is Mr. DIY and Patsen. Okay, Mr. DIY is about retail company for home and daily use product, started in 2005. And on 2020, Mr. DIY has listed on Bursa Malaysia. Mr. Ewa has sub-brands like Mr. Toy and Mr. Dollar that sell toys, tools, stationery and home decoration. Okay, all the stock owned by the company itself, and Mr. DIY also have 1,300 stock all around Malaysia, and also expanding their business to Southeast Asia. Next for Patsen is a department store company that founded in 1987 under Lion Group. Patsen sells clothes, cosmetics, shoes, bag and home items. The store located in shopping mall, and the target audience for Patsen is middle and high income customer. Patsen also offer a local and international brand. Patsen also available in other countries like China, Vietnam and Laos.
Assalamualaikum, my name is Melissa binti Sanawi. My matrix number is A24A3182. Today I will present a short ratio analysis for Mr. DIY and Patsen from 2022 to 2024. The analysis is divided into 4 parts: liquidity, efficiency, leverage and profitability. First for liquidity, Mr. DIY current ratio increased from 1.91 to 2.38 times, and its quick ratio also improved. This shows the company is getting stronger in paying short-term debts. Patsen ratio also improved a little, but the numbers are lower. Next, efficiency. Mr. DIY collected money from customer faster, around 9 to 12 days. Meanwhile, Patsen took longer, up to 76 days in 2024. Mr. DIY also had higher receivable turnover, meaning they collect payments more often. Now, leverage. Mr. DIY reduced 6 to 49%, which is a good sign. Meanwhile, Patsen's debt increased, and its debt to equity ratio went up to 274%, showing it depends more on borrowed money. Lastly, for profitability, Mr. DIY profit margins and returns improve each year. Its return on equity set above 29%. Patsen's profit margin and return were lower but slightly better in 2024. In conclusion, Mr. DIY shows better performance overall from 2022 to 2024, especially in managing cash, profit and debt.
Assalamualaikum warahmatullahi wabarakatuh. I am Muhammad Hussaini binti Kamal, and I'm going to present the trend analysis for company's performance, which is liquidity ratio. Firstly is current ratio. Patsen Holding Berhad had a significantly lower current ratio, which is 0.95 times in 2032 and 1 times in 2033 and 1.05 times in 2034. Mr. DIY had a high current ratio for the 3 years, beginning with 1.91 times in 2032 until increasing to 2.38 in 2034. And next is quick ratio. Patsen revealed a stable quick ratio from 0.80 in 2022 to 0.90 in 2034, reflecting its high liquidity status even after inventory exclusion from current assets. Mr. DIY had a lower quick ratio, which is 0.38 times in 2032, 0.54 times in 2033 and 0.68 times in 2034. Okay, next we are going to general analysis for company's performance for net working capital ratio. Pakson Holding Berhad had a significantly lower net working capital ratio, which is RM120935 in 2022 and RM10783 in 2033 and RM10466 in 2034. Mr. DIY had a high net working capital ratio for the 3 years beginning with RM655268 in 2032 until increasing to RM879587 in 2034. And next we are going to average collection ratio. Pakson Holding Berhad had a significantly lower current ratio, which is 0.95 times in 2032, 1 times in 2033 and 1.05 times in 2034. Mr. DIY had a high current ratio for the 3 years beginning with 1.91 times in 2032 until increasing to 2.38 in 2034.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. So today I'm going to tell about the inventory turnover. So Mr. DIY had a significantly higher inventory lower, which is 2.13 times in 2020, and then 2.20 times in 2023 and 2.33 times in 2034. Pakson Holding Berhad had a higher inventory turnover other than Mr. DIY for the 3 years beginning with 3.73 times in 2022 until increasing to 4.01 in 2023. And then we going to the next about the receivable turnover. Pakson Holding Berhad had a significantly lower receivable turnover, which is 6.09 times in 2022, 5.21 times in 2023 and 4.79 times in 2024. Mr. DIY had a higher inventory turnover other than Mr. DIY for the 3 years beginning with 29.67 times in 2022 until increasing to 40.88 in 2023. Alright, we're going to next about the debt ratio. Pakson debt ratio relatively increased from 72.42% in 2022 to 73.84% in 2024, which is suggests of higher use of borrowed money into finance is assessed. And then Mr. DIY debt ratio was lower over the 0.51% throughout the duration. And then the next, debt to the equity ratio. Pakson debt to equity ratio relativity increased from 1.59% to 2022 to 274.74% in 2024, which is suggests of a highest use of borrow money to finance is asset. And then Mr. DIY debt to equity ratio was lower from the 81.60% in 2022 until 63.44% in 2024.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nuri Syafiqah binti Azhar. My metric number 82483314. Today I want to explain about trend analysis for company performance, which is Mr. DIY and Pakson. First is total asset turnover. Mr. DIY show improvement in asset utilization with the asset turnover ratio increasing from 1.20 times in 2022 to 1.22 times in 2024. However, Pakson still performed better overall in this area. There was a slight decline in its ratio from 0.33 times to 0.32 4 times over the same period. Next is gross profit margin. Mr. DIY Berhad record a steady improvement in gross profit margin, increasing from 41.33% in 2022 to 45.85% in 2024. Meanwhile, Paksa Industri Berhad show consistent growth in gross margin, rising from 50.64% in 2022 to 56.70% in 2024, indicating strong cost control and profitability. Thank you.
My name is Nuraiha binti Roslan. My metric number A24A3128. Operating profit margin, Miss DIY Berhad. Maintain trend from 0.59% in 2022 to 0.69% in 2023 and increase 0.92% in 2024. But Paksa Berhad exhibited steady improvement in its operating margin, increasing from 10.94% in 2022 to 12.26% in 2024. About net profit margin, there was a substantial drop in Paksa Berhad net profit margin over the period from 7.22% in 2022 to 4.53% in 2024. About Miss DIY Berhad, extend its net profitability with margin increasing from 3.45% in 2022 to 6.69% in 2024. Return on equity, Paksa Berhad registered lower return to its shareholders as its return on equity fell from 8.60% in 2022 to 5.86% in 2024. Miss DIY Berhad has decreased 33.01% in 2022 to 26.42% in 2023 and increased to 29.36% in 2024.
Hello, my name is Zulfikri, and today I will be presenting about horizontal analysis of Mr. DIY and Paksa from the year 2002 until 2024. First, we go to liquidity ratios. Mr. DIY shows a steady increase in both current and quick ratios every year. This means that they become better at paying short-term debts, while Paksa also improved slightly, but the ratio stayed lower than Mr. DIY, which shows a weaker short-term strength. Next, we look at efficiency ratios. Mr. DIY was consistent in using its assets and collecting money from the customers. Meanwhile, Paksa took longer to collect payments every year. This could affect both their cash flows and day-to-day operations. Next, we look into profitability. Mr. DIY profits and return increase, showing better control over their costs and income. For Paksa, their profit margins went up, but returns like ROA and ROE dropped in 2023 before recovering in 2024. This shows some instability. Lastly, we go to solvency ratios. Mr. DIY debt's level got lower every year, meaning they are becoming more financially stable, but Paksa's debt got higher every year. This put them at a high risk in the long run. So, to sum it up, Mr. DIY is doing well and improving steadily. Meanwhile, Paksa is facing more risks and financial challenges. That is all.
Next we have recommendation. Recommendation we have for Miss DIY and Paksa. Miss DIY we have expand more into small area like add more branches to gain new customer. Next, strengthen online shopping platform is like update their online shopping platform to give best experience for the customer to purchase online. Next, customer service like Mr. DIY provide training to worker in communication skill. Next, introduce membership program is like make a member card to give a point on purchases and exchange it with voucher or discount. Next, for person we have invest in online sale is like person need to invest more in online platform because this day people change their habit to buy online more than physical store. Next, update store layout and design is they can design new trendy to attract more customer. Next, attract young customer is like keep active on social media like TikTok or make content to make the young customer aware about new item on person. The next, introduce loyalty program is like give a reward to loyal customer that always come and buy product from person.
Assalamualaikum and good day everyone. My name is Niani Sofia and my matrix number is A24B2979. I'm gonna in charge in explaining about sources of funds for the businesses. When expanding a business, choosing the right financing source is a critical strategic decision that affects both short-term growth and long-term success. Companies must weigh factors like their current financial position, projected cash flows, cost of capital, and risk appetite. Internal financing such as retained earnings offer immediate low-cost funding without debt or ownership dilution, but it may limit expansion if profits are insufficient. Debt financing, including bank loans and bonds, provide additional capital but introduce repayment obligations, interest costs, and potential lenders restrictions, requiring careful cash flow management. On the other hand, equity financing through venture capital, IPOs or private investor delivers substantial funding and strategic expertise, but dilutes ownership and involves higher costs and complexity. The optimal choice depends on the company's specific needs, retained earnings for quick, low-risk funding, debt for structured, scalable growth, or equity for high-growth ventures needing significant capital. By aligning financing with their goals and constraints, business can full expansion while maintaining financial stability and competitive advantage. That's all from me. I'll pass to the next presenter.
Okay, next for the conclusion part. Overall, the financial comparison between the two companies show that Mr. DIY is stronger and more profitable than Paksen. The company has also lower risk due to its healthier debt structure and better liquidity. Although Paksen is still in operating, Paksen needs to improve their financial strategy and operational efficiency in order to stay competitive and regain its position in the retail industry.